Welcome to The Explainer. Today, we are doing a serious deep dive, an investment analysis of what really could be the next major wealth creation opportunity in Dubai real estate. We're talking about Emaar's brand new mega project, the Heights Country Club and Wellness. We are going to break down the developer's strategy, comb through the historical data, and project the potential returns for anyone looking to get in on the ground floor. You know, when Dubai's biggest and, let's be honest, most reputable developer, Emaar, places a multi-billion dirham bet on a totally new area, smart investors, they sit up and they pay very close attention. This is not just another project launch. Think of it as a massive market signal, backed by a history of literally shaping the city that an entire district is about to be transformed. So we're here to figure out what that means for your portfolio. All right, let's get right into it. Here's how we're going to tackle this. First, we'll start with the high-level strategy, the why here, why now. Then, we'll zoom right into the specifics of the Heights itself. After that comes the core of our analysis. Two totally different models. One looking back at history, the other looking forward at Emaar's pricing strategy. And then, we'll bring it all together for the most important number of all, your potential return. First up, context is absolutely everything. It is so crucial to understand that the Heights isn't just being built in a vacuum. Nope. It's a cornerstone piece of a much, much larger strategic vision that Emaar is putting into play, and that dramatically impacts its long-term value. Okay, so what Emaar is doing here is creating what you could call the Emaar Triangle. Just look at this map. It's a cluster of three massive premium communities, the Oasis, the Grand Polo Club, and, of course, the Heights. Now look closely at where they're positioned, right at the intersection of Emirates Road and Expo Road. That is a logistical sweet spot. You've got direct access to Al Maktoum International Airport, which is on its way to becoming the world's largest, and you're just a few minutes from Expo City. This is not just about building some nice villas. Emaar is creating an entire economic and residential hub. Seriously, think back to Dubai Hills Estate. Emaar took empty desert and built a luxury city from scratch. They're running the exact same playbook here, but on an even bigger scale. This is the next major residential heart of Dubai in the making. Okay, so that's the grand plan. Now let's move to the project itself and see what's actually being offered in this absolutely critical first phase. Because, as we're about to see, getting in on phase one, that is the whole key. So the initial launch is all about these standalone villas. 3, 4, and 5-bedroom layouts. Now, the key takeaway from this table, it's not just the prices, it's the plot sizes. A nearly 5,000 square foot plot for a 3-bedroom villa, that is exceptionally generous in today's market, where, most new projects are all about density over space. This immediately puts the Heights in a premium category, and it's a huge value driver. These starting prices you see here, $5.5 million for a 3-bed, $7.1 million for a 4, and $9.6 million for a 5, they're going to be the foundation for our entire return analysis. And it all boils down to this one number, 1,650 dirhams per square foot. This is our anchor point. This is the metric we are going to use to compare against history and to project future growth. So remember this number, okay? It is the foundation for everything that's coming next. All right, time for our first deep dive analysis. The best way to predict the future is often to study the past. So how have other Emaar Phase 1 villa launches actually performed over the years? Does this whole Phase 1 advantage thing really hold up? Let's find out. Just look at this timeline. It shows Emaar's playbook over the last decade, and it is so consistent. From Arabian Ranches 2 in 2012 to Dubai Hills Estate in 2016 to AR3 in 2021, and just recently, the Oasis. Every single one of these started exactly where the Heights is today, a Phase 1 launch in a new community. And you know what? Each one was met with skepticism. I remember when Sidra launched in Dubai Hills, people were saying, why would I invest there? It's opposite an industrial area. Well, the early investors who saw the vision have seen their capital more than triple. Same story in Emaar South. This is not luck. It's a proven, repeatable strategy. Now, to get the most accurate projection, we've got to be smart with our data. Yeah, early launches from back in 2002, like in Arabian Ranches 1, saw insane returns, over 700%. But the market was totally different then. By taking out those outliers and just focusing on launches after 2010, we get a much more realistic and, frankly, a more conservative picture of what an investor can expect today. And here it is. This is the result of that refined data.
After we analyze all of these modern Emaar communities, we get an average annual rate of return of 18.7%. Just let that sink in for a second. That significantly outperforms most traditional investments. And this isn't a one-off. This is the average performance across multiple billion dirham projects. It shows a really reliable and powerful pattern of value creation for people who get in on phase one.
Okay, so let's apply this historical average to the Heights. The project is launching now. Handover is estimated for 2030. That gives us a neat 4-year investment window during construction. So if we just multiply that average annual return of 18.7% by those 4 years, we get our first major takeaway, a historically backed projected capital appreciation of about 75% by the time you get the keys. Okay, on to our second analysis. We're going to put the history books down for a minute and use a completely different method. This time, we're going to look forward, using Emaar's own predictable pricing strategy. This is all about understanding the mechanics of how a developer literally manufactures value within a community from the inside out. And this is the pricing ladder. It's simple, but it is incredibly powerful. Emaar launches phase 1, that's the Heights, at an attractive entry price. Then, for the very next release, they increase the price by, say, 5 to 10%, and they just repeat this with every single launch. What happens is the newer, more expensive phases systematically pull up the value of the earlier phases. As a phase 1 investor, you are literally riding a wave of appreciation that the developer is creating for you. And this chart visualizes that ladder effect perfectly. We start at the bottom, our phase 1 anchor price of 1,650 dirhams per square foot. Now, let's be conservative. Let's assume an average price increase of just 6% with each new launch. In a community this big, we can easily expect 12 launches. By the time that final phase is released, that systematic increase brings the developer's price to over 3,100 dirhams per square foot. That's nearly double the entry price. Your property, which you bought at 1,650, is now being benchmarked against new units selling for almost twice that price. Now, for a realistic projection, we have to talk about something called price lag. Okay, when you decide to sell your villa on the secondary market, Emaar is probably still going to be selling their own brand new units. To attract a buyer, you can't match their price. You have to offer an incentive. And that usually means undercutting the developer's price by about 10% to make your property the better deal. So here's the bottom line. Even after we factor in this realistic 10% discount, the numbers are still incredibly strong. We take that final phase price, knock 10% off, and it still results in a total capital appreciation of about 71% from your initial purchase price. This just proves the pricing ladder strategy is powerful enough to absorb the realities of the market and still deliver fantastic returns. So we have now run 2 totally independent analyses. We've looked backward using years of data, and we've looked forward using the developer's own pricing model. Now it's time to bring them together and figure out the real bottom line for an investor in the Heights. The most compelling part of this whole exercise is seeing how closely these 2 very different methods line up. When separate analytical paths lead you to the exact same destination, it gives you a much, much higher degree of confidence in the conclusion. And this slide just shows that convergence perfectly. On one side, our historical analysis projected roughly 75% capital appreciation. On the other, our forward-looking model, even after a conservative discount, projected 71%. The fact that 2 completely independent methods bring us to virtually the same conclusion. That gives us a very tight, very high confidence range for our expected growth. And now we get to the number that really matters to an investor, return on equity, or ROE. See, capital appreciation tells you how much the property's value went up. ROE tells you how much money you made on the actual cash you paid out of your pocket. Let me make it simple. On a typical payment plan, by handover, you will have paid 80% of the price. But the appreciation, that 71% to 75%, that's calculated on the total property value. Because you're getting the full appreciation on an asset you haven't fully paid for yet, your return on the cash you've actually invested is magnified. And that is why the math brings us to a projected return on equity between 88% and 94%. In simple terms, this analysis suggests you have the potential to nearly double every single dollar you invest over the 4-year construction period. Which really leaves us with a final, powerful question. The data, from both history and developer strategy, consistently shows that the greatest returns are captured by those who get in on phase 1. So if you missed out on Arabian Ranches or Dubai Hills or the Oasis, this analysis suggests the Heights presents the next clear opportunity to leverage that exact advantage. The question for any investor now is, can you really afford not to?